I'm just going to sit between you two to, keep the peace. Want to set some ground rules first, obviously. I don't want any name calling, no low punches, okay? We're going to keep this dignified and respectful. I think the best place to start, maybe for folks in the audience who are unfamiliar with maybe the concept of perpification or how it differs from tokenization, we can sort of start with how the models differ in a sense, and maybe the different user bases or client profile that your two platforms, Securitize and Ostium, serve. So maybe we can kick things off with an opening statement, if you will, that addresses that point. I'd like to thank Centrifuge and the Commission of Presidential Debates for having us here today. And based on the coin flip that I did in my head, we'll start with Kaledora.
Thank you, Frank. Thanks, guys, for having us. I'll kick off just quickly a little bit of context on who I am. I'm Kaledora, CEO and co-founder of Ostium. We are building a global markets trading platform that takes a perpetuals first approach. And I'll be arguing the side of perpification, which I'll admit is a term I coined. So for those unfamiliar with said term, the way I would define perpification is basically as a perpetual swaps or perpetual futures first approach to onboarding traditional assets or non-natively crypto assets on chain. In contrast to tokenization, which I perhaps will let Carlos define, but is a approach that holds and custodies the asset that you want to represent on chain, and then has some minting and redemption process, and then represents that through a token itself. Perpification is a much more capital efficient approach, and one that better serves the needs and demands of on-chain users today, and confers all the benefits of what I believe, and I think the data bears out, as being by far the best and most sort of user-friendly, non-spot primitive in crypto. Perpetual swaps, for those who are unfamiliar, are the leading derivative in crypto. Perps are 70 times larger than the options market in the space. Very simply, to define what a perp is, or sort of a perp-like instrument, it's an instrument that is synthetic, so one that doesn't give you claims on the underlying, that allows you to track the price exposure and sort of take a directional position on the price of an asset in a synthetic fashion. Easy to long or short, offers some amount of leverage, obviously platform dependent, and then, as the name suggests, is perpetual, so does not expire. These instruments are linear. I think very simply the reason they've become so large and have become the dominant primitive in the space is because they allow people generally prefer, they want to take a position long or short, they want to bet on a direction, they want to adjust their leverage based on risk tolerance. Much simpler than say options and other instruments that you have to roll and so forth. So to summarize, we believe that perps are sort of the dominant and the best retail primitive, or the derivatives primitive out there, and are a far more capital efficient way of onboarding traditional assets into the space. And that's what we're doing. So very different from sort of the tokenized approach.
Perfect. And Carlos, the tokenization perspective is what?
So first, thanks to the friends from Centrifuge for the invite. I've been doing tokenization as long as they've been doing together. So almost 8 years now in the space. And the whole thesis of tokenization is the following. So capital markets have a lot of inefficiencies that they've been built with technology from the 70s. And most of the activities you do in capital markets involve updating ledgers. You have to update the ledger of record of who owns a security when you move them. You need to update the ledger of record of the dollar that is involved in the transaction, etc. So everything you do in capital markets today is about updating ledgers, and those ledgers are very outdated. And then, public blockchains are a better form of ledger that allows you to basically upgrade capital markets. So tokenization is about taking existing regulated financial products and then upgrade them to a better ledger technology that allows you to do, a better fractional ownership, more democratization of the asset, better, faster settlement, eliminate counterparty risk, provide higher liquidity, etc. So this is about taking a real world problem, which is capital markets, and upgrade it and make a better version of it that makes it more accessible and more available, and a better version, as I mentioned. So perpification is perpetuating the casino that crypto is by providing another way for people to gamble on the asset price without providing an intrinsic value. It's an unregulated activity. This is why it's prohibited in the US as opposed to tokenization, which is regulated. And I have some friends from the SEC here that probably will have an opinion later. So for you to understand, this is about the main difference is whether you want to speculate in price and have fun with it, which is, fair enough, but, taking all the risks of being liquidated or operating in unregulated, unlicensed platforms that are offshore, et cetera, versus actually owning the real asset and being, subject to all the investor protections that today capital markets have, but with a better version of the same assets. So just to make sure everybody understands, this is like, some people like to go and see MasterChef on TV, and that's great. You have a lot of fun watching, and some people actually like to go to a Michelin star restaurant and eat a good meal, right? So these are two very different experiences. One of them is pure fun. You don't get anything out of it. The other one, you actually get a really good meal that has been built by somebody that has worked as a chef for many, many years and produced something for you of value. So these are two different things. The user profiles are obviously very different. Perps are for crypto degens that just want to speculate on price. We are trying to help people build better futures and more savings, etc., by providing better assets in a better ledger format.
Okay, there's a lot to unpack there. There are some fighting words from Carlos. I mean, he's basically equating
This is what we're supposed to be doing here, right?
tokenization is the Michelin star restaurant of crypto financial innovation, whereas perps are the McDonald's. What's
I heard. All right. Well, I have to respond to those fighting words. All right.
And I'm going to try to keep you guys at a 1 minute, 2 minute minimum. So I might cut you off, but I'll give you that minute and a half rebuttal, and then I'm going to ask the first question.
Okay. The claim you made is a straw man argument. If that were true, you would be dismissing the entire value of all derivative or non-spot markets in the first place. And I will just say this is something that's been said time and time again. Every time there's been a new derivative primitive that has taken off, people said the same thing about grain futures in the 1900s. They said it was going to lead to a bunch of speculation on wheat. Commodity futures have obviously become the linchpin and backbone of the global physical commodity markets. People said the same thing about S&P futures. They are now the most liquid index market in the world in the 80s when index futures were started. So people say this all the time. There's a classic saying in tech that goes, the next big thing will start out looking like a toy. I think the same is true in crypto. And honestly, people said this about Bitcoin in the beginning. We wouldn't all be here in the first place, and this wouldn't be a space that exists if some people didn't take a bet on an instrument that looked like a toy, and that many argued the argument that was used to dismiss basically all of crypto and everything that we've built in the space and Bitcoin in the beginning was an argument that sort of put it into the bucket of pure speculation without any intrinsic value. So I would say that is a straw man argument, and there's demonstrable evidence that having novel derivative primitives that allow anybody to hedge, they start out looking like a toy, they start out looking like a tool for speculation, and in all of the cases I denoted and many more.
I'm just waiting for when onion futures roll out on Ostium, because that's if anybody's familiar with the 1952 Onions Act, Futures Act. So let's start maybe with stocks.
Can I have a rebuttal? Or
no. Everybody gets one rebuttal. So let's start with the first question, which is pertaining to stocks. I think a lot of people, when they're either thinking about tokenization or perpification.
Even the name is complicated, right?
Perpification. They think about credit, which is in the domain of Carlos. So they think about different assets like oil and gold, which I think you guys give users access to. But for the lion's share of investors who care about investing in U.S. equities, maybe they don't see the problem. U.S. equity markets are the most robust, liquid in the United States, in the globe, excuse me. And on a daily basis, the New York Stock Exchange trades 1 billion shares a day. For most investors, costs are near zero to trade equities. Why should they be excited about perps?
Great question. So I think we are incredibly privileged to have very advanced and well-functioning capital markets in the US. That's not the case for most people around the world. And I think sometimes it's maybe difficult for us to grasp the lack of access that most people have around the world. US equities are certainly very easy for people in the US to access, but not for people in many other jurisdictions. They usually can't actually buy the underlying asset. They have to jump through all sorts of hoops. If they can't access the underlying asset, they usually go through shady offshore FX brokers that have usually very
Any shady
interesting
FX
process.
brokers in the house?
Yeah, so instead of going through a shady FX broker, you go through a shady perps unregulated exchange offshore. What's the difference?
The difference is the value in providing
different level of
something through
shadiness, right?
a
One is
transparent
crypto
on-chain
shadiness.
platform that people can access with a wallet, and that provides universal, transparent access to assets.
Well,
But
let's
you
talk
know,
about
you know
trans-
that the reason
Well,
U.S.
well-
equities are difficult to access offshore is because they're regulated, right? And a lot of countries offshore, they don't have the proper regulation to offer U.S. equities. And the reason that now perps are accessible to offshore is because they are unregulated. So people basically don't follow any regulations. This is why they're accessible. If they were regulated, you will have the same problem. Like,
But if we think about the topic of transparency, it could be argued that Securitize relative to Ostium is not as transparent and against.
no, our assets are on chain. How is not that transparent?
I mean, it's a centralized. How do you defend the model's centralized nature?
So in anything regulated in crypto, there's going to be a centralized component and a decentralized component, right? Like nothing in crypto is really fully decentralized, like a hybrid of a centralization point with a decentralization point, including perps, by the way. So this is this.
But
this-
would you not say that they're more decentralized than Securitize?
Well, because they're unregulated, right? So if they were regulated, they will have to like add KYC, let's say, like we do, right? Like she was talking about the Standard & Poor futures being the most liquid thing, blah, blah, blah. That's because they are regulated.
I have to step in here.
And those are regulated. That means you have to do KYC, you have to onboard investors, maybe whitelist wallets, etc. And then the actual trade of movement of the assets can be decentralized, which is what you do with tokenization. So of course, when something is fully unregulated, then you can make it fully decentralized. The moment it's regulated, you have to add some degree of investor protection, KYC, etc.
Rebuttal.
Yeah, so
I thought you said no rebuttals.
No, I said everybody gets one.
Okay.
there's I would say that's another strawman argument. You're conflating a lot of different things into a single into one point. There is I think decentralization, actually, I would try to define this term a little bit more clearly. There is censorship resistance, there is transparency, there is levels of verification. You can build something that has identity verification, for instance. You can have a front end that verifies someone's identity in order to onboard and blocks them from interacting with the front end. And the infrastructure itself, or the set of smart contracts that's deployed, is decentralized, whatever you want to call it.
That's what tokenization is.
I mean, look, you still have to custody the underlying asset, right? There's still a very clear centralization
this is a
point.
fallacy. This is not true. So every entity in the US that the custody of the asset basically is an entry on a ledger, right? So if you use a public blockchain as your underlying ledger, the asset is not a physical asset that you have to custody. If you were to tokenize gold or commodities, yes, when you tokenize securities are dematerialized. They don't exist physically anywhere. When you say people custody the asset, it means there is a regulated intermediary that controls an entry on a ledger. So if that ledger becomes a public blockchain, that's the only place where the asset actually exists. If you do native tokenization, of course, there's a bunch of people doing derivatives where they use a broker dealer to issue a derivative, etc. That's a different story, and I agree with you, that's a bad model. But native tokenization just means that the regulated intermediary that issue the security or controls the security uses a public blockchain, and that's the only place where the entry of the ledger exists on a blockchain.
Sure. Okay. Sure. But nonetheless, that doesn't discount my point that there is obviously a centralization point. You, as Securitize, can obviously blacklist certain wallets. I mean, you can only do transfer of the securities that you guys issue on whitelisted wallets.
Because they're regulated.
Right.
And
Okay.
send the security to somebody in North Korea. Don't you agree that's a good thing, by the way?
I don't think that's a good thing. But my point
we should
is,
send securities to North Korean people or Hamas or.
I'm not advocating for that. But my point is, you are conflating multiple things. You are conflating decentralization of the infrastructure or some level of censorship resistance on the way that contracts are deployed and the way that people can interact with the system with identity verification itself. Those two can be the same thing, but they're not necessarily.
But by the way, the ledger we use, let's say if you use public Ethereum blockchain, is censorship resistant, right? So nobody can go and tamper with, even a centralized actor will not be able to actually modify the content of the ledger, right? Because it's recorded there.
Yeah.
So if somebody tries to tamper with it, you will be censor resistant, as opposed to traditional capital markets technology, where somebody can actually change the database and nobody will know that you've change
Yeah.
the records and things like
Yeah,
that.
that's certainly
So,
true.
Maybe we can approach the conversation from the vantage point of product market fit and which aspect or which approach maybe is finding better product market fit. I think we were at a dinner not too long ago or an event where someone raised a point that obviously perps are the biggest product in crypto, so it'll be easy to make that argument.
Correct. You know why?
Well, because speculation is very interesting.
No,
in
and
crypto.
because they are unregulated, anybody can access them.
Sure, but a lot of
So, of
things in
course.
crypto that were unregulated later became under the regulatory scope.
Correct. And so,
Poly
will,
markets,
so
for
will
instance.
be perps.
But let's focus maybe on something that's been said about tokenization of different types of credit funds. That it's really just a way to market funds that don't have appeal to the traditional market. So we slap crypto on it so that it's more
That's
interesting.
actually not true. So the two tokenized credit funds we have, both of them are billion-dollar funds from two of the most reputable, credit institutions. One is Hamilton Lane, and the second one is Apollo. And those funds have already product market fit on TradFi with billions of dollars of AUM, and now they're trickling down into crypto. So it's not taking. And by the way, and I agree with you that tokenization at the beginning was similar to, let's say, crowdfunding, where it had an adverse selection problem where like the shitty deals that nobody wanted in TradFi will come to crowdfunding or will come to tokenization, but that's no longer true. Today you have high quality issuers that have billions or trillions of dollars in some cases like BlackRock that are bringing those assets to crypto because it's a better way of representing the assets and moving them around and do things with them, leverage the asset, etc.
Is it a better way of representing the asset?
That doesn't represent the asset, speculate on price.
Through tokenization, I think
Or expressing a view on an asset?
I think, look, I would differentiate between the value of taking a spot or derivatives first approach. I also think, maybe just to recenter the conversation, it is, we're serving two fundamentally different customers and two fundamentally different value propositions. Securitize's customers are asset managers who want a way to experiment with holding assets in a blockchain without having to build all the infrastructure in-house. And so they go and they abstract that for them. And your customers are largely, they're asset managers. They're
We
funds.
also have the investors on the other side, right?
Right,
Like
who
we
want
sit
to
in
buy
between.
yes.
Who want to consume the asset. So
Sure, it's a two-sided market, but fundamentally you're primarily servicing asset managers, making it easy for them to make their funds available to other people. We have a completely different market. And I think it is, not to say straw man again, but I think it's a straw man to pit spot and derivatives against each other. They work together. The argument that I'm making is that for most assets and for most of the demand that exists on chain today, people there isn't actually demand to sit on the entire universe of traditional assets, to sit in spot on most traditional assets. Certainly, if you are a protocol and you have a treasury and you want to put your capital into something that is safe and that is yield bearing, BUIDL might be a great solution. But for most of the demand and for most of what people are doing on chain today, and also as the space matures, people are largely trading. The space is driven by a lot of trading and also by being able to express directional positions over shorter time periods, not simply sit passively in assets. And so the markets that we are, but to be clear, I think I know what you're going to say, and you're going to talk about retail versus institutional. Look, trading platforms, Robinhood, for instance, obviously services both a retail and an institutional clientele, but a different institutional clientele. The Citadels and hedge funds of the world that are on the other side of those trades, and that they also interface with, who are equally clients as perhaps their retail-facing clients, are also institutional, but it's just a different profile. And to argue that there is only value in servicing asset managers and long-term, just simply sitting on assets long-term, that there's no value at all in basically building out, liquid markets for trading through better instruments, by the way. The argument I made at the very beginning is that perpetuals are one of the single best inventions in crypto. I think there's three really good inventions in crypto: AMMs, prediction markets, and perps. And I think there are three examples of two things that are truly novel to crypto. One thing is repackaging stuff from the traditional markets. If you want to look at things that are truly novel and innovative and interesting, and I think probably everybody is here today because you're interested in technology, and it's I think one of the only places where you see a true pace of market structure innovation. Perpetuals are in that category. They are one of the coolest things. I imagine probably many of you have nerded out about this. They're one of the coolest things in the space. And, they start out looking like a toy. Yes, they service some speculative interest, but ultimately they wind up, these instruments that allow people to express views in a novel way always ultimately wind up being very important venues for hedging from an institutional perspective as well.
The debate is not retail versus institution. So first, we are a two-sided marketplace. So yes, we have asset managers on one side, but we have retail also of individual investors and institutional investors on the other side buying things. So it's not that we are only serving asset managers and everything we do is what for the benefit of the asset managers. It's actually the opposite. Unless we do things that the investors want, the asset manager will not work with us because the asset manager ultimately what they want is more AUM. So that's actually not true. Second, like you're conflicting, marketing innovation with allowing retail people to take 100x leverage and be liquidated at any time without knowing what they do on an offshore, unlicensed, unregulated place. That's what I think is fundamentally wrong. And it's true that derivatives are very big in the US, but because they're regulated. And most of the people trading derivatives are not retail people because the retail people are not allowed to trade derivatives freely for a reason. And Robinhood does the retail, but Robinhood is a regulated institution. So you can't compare what Robinhood does with what, offshore perps do. So I think the fundamental problem here is allowing retail people to participate in an area where you can get like 100x leverage and get liquidated without knowing what you do, without any investor protections. I think that's fundamentally wrong. And that's, what led to FTX going down and Celsius and so many companies that were basically...
Well, FTX was a centralized entity. The decentralized...
Yeah, with no level of
You're
transparency.
still allowing people to participate on markets that they don't understand and take a massive leverage and could be liquidated without them knowing what they do. Retail are in every single country. The only common thing about regulation in every single country is investor protection for retail people. Because if you're an institution and you get liquidated, that's your problem. You're an institution, you have money, or you close down the shop and that's it. But if you're a retail person and you're gambling away with your savings and then you lose them because you're doing something that didn't have the right investor protections or disclaimers and you lose your money, you basically are losing your savings for life. You're losing your pension. You're losing, the ability to pay your mortgage. So we should take more seriously how we're exposing retail people to these highly risky assets just for the sake of speculating. This is it's like building another Las Vegas, another casino, but you don't even get free drinks.
Do you think that there should be no DEXs, no KYC, lending protocols? Or...
I think anything that touches financial instruments that retail people have access to should have some degree of investor protection. Yes. And by the way, KYC is a different story. KYC is not about investor protection. KYC is about money laundering. Do I think that we should prevent terrorists from accessing, money illegally? Yes, I do think so. Because otherwise they kill people. So I do firmly think so. Is there a way to do it in a way that you don't stop? Like, look, I'll give you another example. In 2016, when I first opened an account, I opened an account in a very large exchange. I'm not going to mention the name because no need to shame anybody. But you could open an account, a crypto exchange account with a username and a password. And they will limit like how many Bitcoins you could trade per day. That back in the days, things were measured in number of Bitcoins, not anymore. And then, obviously there was a lot of illicit activity happening in crypto for the right reason, because it was all anonymous and permissionless. And then, all regulators worldwide, they force decentralized exchanges because that's how they can control it to introduce KYC. And a lot of crypto people were telling me, oh, crypto trading is going to tank. Nobody wants KYC. Guess what? It's like maybe grown 100x in terms of trading volume since KYC was instituted. Why? Because more people access it, the more people feel comfortable with it. So the fact that you have to KYC, it doesn't mean that people are not going to use it. Like, look, you were talking about Robinhood. Robinhood does KYC and it has 40 million of daily active users. So nobody cares about that thing. People understand that it's something you have to go through. It's very frictionless these days because it's all automated, digital, very quickly. And that is there for a reason, right?
So I'm not taking
exchanges trading volume in the US or in worldwide in crypto, which has KYC, is like 100 times more volume or 1,000 times more volume that, non-KYC DEXs. So in aggregate, like the DeFi.
I have to do more with UX.
It's not a debate about KYC or no KYC. have a strong, I don't disagree with a lot of the broad strokes of what you said, but I think you're making two fundamental claims that I think are mistaken. The first one is assuming you're looking at the current state of affairs and you're assuming that either one, there is a clear regulatory framework for a lot of these new primitives and the new types of instruments that are being invented in the space, and assuming that there won't be a path forward for those things, that the regulatory environment won't evolve. There was absolutely, zero environment 10 years ago. I mean, I think it's kind of crazy how much the space has changed in the last couple of years. Who would have thought that there would be, Bitcoin ETFs, that governments would be buying Bitcoin? That was an absurd proposition 10 plus years ago. So the space evolves, the regulation catches up. I'm not arguing that this stuff will never be regulated in some fashion, and I think that would be a good thing. I think it would be wonderful if there were updated regulatory frameworks for some of these longer tail novel primitives, things that are fundamentally new that don't fit neatly into something. And secondly, I would say there's a reason why people are building this stuff in the space, because when there isn't a clear framework, innovation has to come from the outside. There's a reason why the taxi companies didn't build Uber. Uber built Uber.
There's one
No, but
element. There's.
We're running out of time.
No, they gave us more time.
Oh, really?
Yeah, I tipped the bouncer.
You took the
$100,
bouncer?
yeah.
Okay.
So they gave me a few more minutes.
I just want to make sure we do the closing statement.
Yeah, of course, you'll get the closing statement. I mean, on one side of what you're saying is, yes, speculation and leverage is an issue. On the other side, right, there's more capital efficiency.
It depends what you want. What capital efficiency for what? For speculating on price, for sure. But,
You could say that about any
capital
future or any
efficiency and that
option.
liquidity,
Like,
liquidity comes at a price. Like, these are completely two different things. In one place, you're actually owning an asset that there's protections about what you actually own, and you own the asset to build long-term value. And the other one, you're just speculating on price. This is like going to Las Vegas, right?
Carlos, I don't think you're going to win the argument that only spot is relevant and we shouldn't care about derivatives.
No. By the way,
That's not a good argument.
That's not true. Like in the US, there's very healthy derivatives markets that are regulated and that, for the most part, not
So
accessible
what happens
to
if
retail.
they
And-
get
Okay, but that's a
regulated,
separate
then?
argument around regulation, which
If
is
they get regulated in some capacity, then where's your argument?
No, if they get regulated, a lot of the things they do, like 100x leverage for retail, will disappear, and then perps will not be as attractive as people think they are.
I
and
would
they
never
will not be as
argue
liquid as they think they
that
are.
to fit into a regulatory regime, you don't need to modify your product. That's apparent to me. And I think if you look at how,
I mean,
look
you
at
do.
any
I
of
mean, we
these,
security issue, permissionless.
look at Binance's
tokenized.
expansion into the US or anything else. You have to, I mean, it's not an argument. Like, if you have to fit into the regulation, every country is going to have different rules and will require different things of you. You modify your product based on their expectations. If there isn't a clear framework, you don't fit into that expectation. You can modify it, but it doesn't necessarily change the core value proposition or the core architecture of the product. You can modify it's not.
But
It is
regulations
not
change.
rocket
Like,
science to modify
people
leverage
think
levels.
regulations don't change. Like, tokenization is predicated on using a better ledger technology, right? And then the SEC, in this new SEC that we have now, has publicly admitted that, let's say transfer agents like us can actually use a public blockchain as the ledger of record to record the securities, which means native tokenization is now legal in the US. So regulations do evolve, and then you're going to start with an assumption, because we started doing that, tokenization using a public blockchain as a transfer agent without having 100% regulatory clarity whether it was legal. But was it like an assumption that this was going to become legal because it was not a departure from the investor protection rules, etc.? Yes. So, but there's certain things that obviously are completely different. And I think just besides the regulatory issue, I think that the main topic is who you're serving here. Are you serving
Well, you're
the
both
people?
serving crypto people. I mean, if you look at the lion's share
but
of
within
the,
crypto. First, I think that yes, that's a crypto degen thing. My
So
hope
is
is
yours.
no.
yes, come on,
Tokenization. I hope
80% of the people that use BITL
That's true.
are just people that
100%.
used to put their stuff in stablecoin and want to yield.
today. But the idea
And why
is
do
that
they have stablecoins in the
tokenization
first
Probably
place?
99%.
upgrading capital markets. Why is only crypto people using tokenization? Because to use tokenization, you have to interact with wallets, with blockchains, with stuff like that the traditional investors have friction using, right? But this will disappear, right? Like, now stable coins are legal, which were not before. That was a point of friction. So that point of friction will disappear. Then probably we're going to get at some point wallets integrated with like browsers and with brokerage accounts, and then that friction point will disappear. The same way that connecting to internet at the beginning had a lot of friction, right? You had to download a TCP/IP stack, and then you have to install modern software and connect the model and do dial-up and blah, 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 and then that disappears, and now you open your laptop or your phone and you're connected to the internet. The same thing will happen to blockchains, and then tokenization will just be an upgrade for existing capital markets, as opposed to something which is pure casino price speculation thing that doesn't solve any actual problem. It just allows people to gamble better or more.
It looks like we're coming up on time.
We don't know the time
Are
anymore
we-
because
are
the
we
clock
still gonna
stopped,
be
and then
okay
Frank
to-
is here now.
Are we still going to be okay to go to Peter Luger's tonight?
We're having
or
dinner
It's gonna be
together, by
great.
the way, so we actually like each other, but
Somebody might have to warn them that, So maybe we can do some.
You keep the steak knives away from both of
No,
us.
seriously. I'm very
we were
concerned.
trying to be controversial on purpose, by the way.
They were
so-
very nice on the call. I don't know what's going on. I feel like who's going to keep the family Bible once these two get
Come on,
divorced?
do the closing.
We'll do
1
our closing
minute
statement. I
without
think
the
this has
clock.
been a very fruitful
Okay,
debate.
1 minute for the closing. I'm counting down from
All right.
8.
I've stated my case. I will. I want to just go back to first principles on why we're all here. I think probably everyone's here for slightly different reasons, but what brought me into the space in the first place was two things. One, the values, which we have not always been perfectly espoused by everyone in the space, but I think the vision and values of increasing market access, permissionless to some degree, obviously it's on a spectrum, of new primitives, experimentation, just of new market access, transparency, censorship resistance. Those values, I think it is incredible how much the space has evolved in the last couple of years and how institutional it's become. And I'm, grateful for how the space has evolved. But I think staying true to some of those core principles and not compromising on all of them is an important thing. And the second thing is on actual just the nerdiness of new primitives and new market structure. I think for those of you who maybe haven't looked into perpetuals into too much detail, I would maybe highly suggest you go down the rabbit hole. Perpetuals are an extremely elegant instrument, and I think are currently dramatically underrated as a means of just expanding both, to, as he alluded to some degree speculation, but also hedging capacity on traditional markets. And I think there's a huge greenfield opportunity in applying perps, which have clearly found product market fit in crypto, and truly not just because of the speculation case. I think they are just a simply more elegant instrument. And you see this with the fact that they're nearly 100 times larger than the options market and expanding that to other traditional assets. So both have a place. I'm not going to mistakenly pit spot and derivatives against each other. They both should work in tandem and work in concert. They service different use cases and different customers. But I think to frame this as like a Bitcoin BTC ETH ratio, I would say the tokenization to perpification ratio has peaked, and I think the more are starting to see the opportunity in perps, and I think they are dramatically underestimated as a means of not only being very useful in crypto, but ultimately being useful in the traditional markets. And I think you're going to see that change a lot in the coming years. So.
All right. So first, I just want to admit something. The perps are fun. Yeah, definitely they're fun. This is like, when you go out drinking on the way back home, you stop at a gas station and buy sushi, and it feels really good. And you bought sushi in a gas station, and the day
What's
after,
that Spanish
you
beer?
regret doing that.
The Mazao? Is that Mizzou? What's the Spanish beer?
The what?
The Spanish beer, the red one.
The what?
The hobo beer that the hobos drink.
Oh, Mao?
Wow.
So yeah, this is something that is short-term rewarding, and you feel bad the day after, and you regret you've done it. So this is very different than tokenization, when you're actually getting a real asset that you can own. You can earn yield on it. You can earn sweat. It can help you with your retirement. It's regulated. It's safe. It's there for you to do it. So at the end of the day, this debate, since we're probably running out of time, it boils down to two very different things. One thing is, do you want to take $1 trillion of assets that are in outdated ledgers, inefficient, that are not accessible, that have all sort of rent seeker people and intermediaries and tolls, etc., and take that $1 trillion and improve it and make it more accessible and more higher yield generation or more tradable, remove intermediaries and cost of owning the asset, etc. Or you want to take $1 trillion on margin calls for retail people, playing in a casino that doesn't give you free drinks, right? So that's basically what I think the difference between perps and tokenization is. So, thank you.
Thank you.
Thank you, guys.
Let's